Welcome to KPMG's podcast on ASU 2014-13, Measuring the Financial Liabilities of a Consolidated Collateralized Finance Entity. My name is Dan Amat, and I'm joined by Jared Silver. We are senior managers in KPMG's Department of Professional Practice. In recent years, there's been diversity in practice in the accounting for the measurement of financial assets and liabilities of a collateralized financing entity, or CFE. In November 2013, the EITF reached a final consensus to measure the financial assets and liabilities of a CFE based on either the financial assets or financial liabilities, whichever is more observable. The ASU was finalized in August 2014. Jared, would you be able to provide us a little background on this ASU 2014-13?
Certainly, Dan would be happy to. A CFE is an entity that holds financial assets such as asset-backed securities, and issues beneficial interest to investors. These beneficial interests are usually debt instruments that are considered financial liabilities under U.S. GAAP. And because a CFE usually has little to zero equity, it is typically a variable interest entity under U.S. GAAP and subject to the consolidation requirements that apply to entities not controlled through voting equity interest. Consequently, an entity may be the primary beneficiary of and be required to consolidate a CFE for which it is the asset manager, even if it owns no equity or beneficial interest in the CFE. An asset manager may be the beneficial interest in the CFE that is a VIE because it has a power to direct the activities that most significantly affect the CFE's economic performance by making decisions about the CFE's investment portfolio. An asset manager may also have the right to receive benefits that may be significant to the CFE through a subordinated management fee. Many reporting entities that need to consolidate a CFE elect the fair value option for all the CFE's financial assets and liabilities. Although CFE's assets are the sole source of repayment for its beneficial interest, and its beneficial interests are entitled to receive all the cash flows from the CFE's assets after payments of management fees and other expenses, there are fair value differences between the CFE's assets and beneficial interests. Those differences may be caused by different liquidity discounts and duration mismatches between the assets and liabilities. So, as a result, there is diversity in the accounting for these differences between the fair value of the consolidated CFE's assets and liabilities. Some primary beneficiaries record the initial difference in fair value as a gain or loss in the consolidated income statement, while other primary beneficiaries do not record a gain or loss in the consolidated income statement, but instead record it directly to appropriated retained earnings.
Okay, thanks, Jared. That's helpful background. So, what was the result of the ASU to remove this diversity in practice?
Well, Dan, as a result of the ASU, the assets and liabilities will be measured on the more observable of the assets or the liabilities. This means that if the reporting entity determines that the assets have a more observable fair value, then the value of the liabilities will be measured based on the fair value of the assets. Similarly, for the liabilities, then the value of the assets will be measured based on the fair value of the liabilities. The assets and liabilities will be presented at gross, and the non-financial assets will be measured based on the other applicable U.S. GAAP. The fair value of the beneficial held is measured separately even if the fair value of the assets is considered more observable.
Will an entity be required to apply this new standard to all CFEs?
Well, Dan, I'm glad you asked. Entities will be able to elect this measurement alternative on a CFE by CFE basis for those CFEs within the scope of the standard. The EITF agreed that this alternative fair value measurement approach should only be applied in situations where the CFE holds 1. Financial assets and liabilities measured at fair value through net income, 2. Assets or liabilities that are incidental to the financial assets or liabilities measured at fair value, where the carrying value approximates fair value, and non-financial assets that are held temporarily as a result of default or an attempt to restructure by the debtor on an underlying debt instrument held as an asset. Assets transferred to the CFE by the parent would retain the parent's measurement basis, either fair value or amortized cost. The task force discussed that it would not be appropriate to permit entities to transfer assets previously measured at amortized cost to a CFE and use the transfer between entities under common control as a reason to measure those assets at fair value to recognize a gain.
Thanks, Jared. Let's go through a quick example. Assume a reporting entity parent transfers assets that were recorded at fair value through other comprehensive income to a consolidated CFE. The assets were valued at 101 using unobservable inputs, and then the CFE issues beneficial interest with an observable fair value of 102 based on those assets received from the parent. how would the parent account for the CFE's assets and liabilities in that case?
Well, Dan, that's a good question. The transfers of these assets would not be within the scope of this measurement guidance because they were recorded at fair value through OCI prior to their transfer. Therefore, this CFE would not be eligible for the alternative fair value measurement approach because the assets were not recorded at fair value through net income prior to their transfer. If we were to, let's say, change the example and say that the entity elected the fair value option and the changes in the fair value of the assets were recorded through net income prior to the transfer, then this entity would be within the scope of this guidance, and the parent of the CFE would be able to measure the assets of the CFE based on the more observable of the asset or liability values.
Thanks, Jared. One final question. What's the effective date and transition for this ASU?
Well, Dan, for ASU 2014-13, this is effective for public entities for annual periods and interim periods within those annual periods, beginning after December 15, 2015. For non-public entities, the effective date is annual periods ending after December 15, 2016, and interim periods thereafter. In regards to transition, an entity may apply the amendments in the ASU using a modified retrospective approach by recording a cumulative effect adjustment to equity as of the beginning of the annual period of adoption. A reporting entity may also apply the amendments retrospectively to all relevant prior periods, beginning with the annual period in which the amendments in ASU 2009-17 were initially adopted.
Thanks, Jared. That concludes this podcast. For more information like this on other ASUs and FASB projects, please visit KPMG's Financial Reporting Network website.